questions? Okay, BK, so tax liens. 15 years on unpaid, 7.5 years on paid from the date of payment. How many of you know that the IRS just passed a law and have put it into play that if you have a tax lien and you set up a payment arrangement or you pay it off, if you fill out form 12277, they'll remove it from your credit report.
What is?
You did know that.
Yeah, I knew.
You're awesome. The IRS just enacted a policy within their own that if you have a tax lien that you've negotiated a payoff or you pay it off and you send in the form, they will remove it from the credit report.
Does it have to be paid or just during the payment process? I have a client who's actually dealing with this.
According to what I read in the statute, if you have established a repayment program that will end up in the note being paid off,
Okay.
you have to send the form in, and I think it's 12277.
Okay.
Oh, it's right there. Duh. Okay, judgment, 7 years from the date the judgment's filed in court. Delinquencies, 30 to 180 days can remain up from 7 years from the date that you missed the initial payment. We'll go on, I'll talk about. Collection accounts, 7 years from the date you missed the initial delinquent payment. It is against the Fair Debt Collection Practices Act to redate a debt. You cannot sell a debt to another collection company and then they redate it when they have contact with you. It's highly against the law. It's a $2,500 fine. There's not a judge in the land that wouldn't give you an award if you took anybody to court for that. Happens all the time.
What is that?
Collection accounts. Portfolio Recovery, one of the largest collection companies in the world, has 6 different offices. If they go to collect a debt and you challenge it with a validation of debt letter and they can't collect it, they sell it or they give it to the Richmond office. They'll do the same thing. Once you challenge it, they'll give it to the Pennsylvania office. Then they'll send it to the California office. It's just this vicious cycle. They're the worst. But a collection account is 7 years. They have 7 years to collect the money from the day it went delinquent. That's when the time clock starts. And if they don't do it within 7 years, they can't come get it. And some statutes are less. Some states are 5 years. Verbal contracts, written contracts. I mean, there's different states that have different requirements, but 7's the minimum. Maximum. Oh, sorry. Charge off accounts, 7 years. Everything's right around 7 years. Closed accounts, delinquent accounts for 7. Positive accounts remain for 10. If anyone ever tells you your credit report's 15 pages, you need to go in and clean it up, don't ever do it. Please don't ever do it. I actually had a lady that did that because she wanted a smaller credit report. It was sad because she couldn't buy the house she was in. She didn't call me, she just did it because the realtor said, well, it was a realtor, but they said, hey, you may want to get some of this stuff cleaned off because these accounts are really old. So she went in, she challenged them on her own, actually did it online, and they took them off. Her credit score just went poof. So you want positive accounts. Even if there's 100 of them, you want positive accounts, always.
Is there any way to figure out like how much, so you're saying like each credit card can be worth like 16 points or 25 points. Is that all just a mystery and that's something they assign and there's no way to figure it out?
And I got a slide, I'll go into that. But and the short answer to that question is your credit DNA is yours. So your credit for you is established when you started credit. So if you have, depending on how your credit algorithms are scored, your credit card may be 16 points. Same scenario, his credit card may be 18, his may be 5, his may be 10. So it doesn't, Congress took them to court to prove how they did it, and there was thousands and thousands of algorithms. They couldn't prove it. It's just, there's no way to say, and there's a lot of things you don't have control over, like how old you are, what your job title is, where you live, if you rent, if you own, how long you've had your job, things you can't control that have impacts on your scores. And I got a slide to go over that, but there's no way to say, hey, if you pay that card down, you're going to get 10 points. Anybody that comes to you and says, hey, I guarantee you pay this card down, you'll get 25 points. No way. We can't. The lending industry uses analyzers, and they use analyzers fairly effectively, and they're approximate ranges, and they use these analyzers, like Credit One uses an analyzer, and they go in and they figure out if you do this and you do that. It's an approximate range of what points you can get, but it's never going to be until you actually see your credit. And you all know the difference between a FACO score and a FICO score while we're on that, okay? If you go to creditreport.com or creditscore.com or any of the consumer sites and you pull your credit score, guaranteed it's going to be higher than if a lender pulls your credit. So that's a FACO score. That's what I tell my clients. A FICO score, obviously, is when a lender pulls your score, they pull directly from the repositories. The lender has already factored in risk with your loan. So if you go pull your personal score, and this happens all the time, let's say you get a score that's, an 800, and then you're like, I got an 800 score, I just checked it on freecreditreport.com. And then you go to your lender, and the lender pulls your credit, and now it's a 740. Well, what's the difference in this 40, 60 points? The difference is the lender has built risk, and it acts as if you've already been given that loan. That's why there's a difference between your consumer report and your risk report. Each lender tweaks their software from FICO when they get in the system with them. And they say, we want 35% risk on this. We want 25% risk on this. And they build the software. So you go to one lending institution and it's 740. You go down the street to the next one and it's a 760. You go to the next one, it's a 720. Well, how the hell can it be three different scores? Because each lender builds in their own risk factors. So if you ever have a client that says, I have an 815 credit score, and 821 is the highest I've ever seen, by the way, and they say have an 815 credit score, ask them where they got it. If they say, I got it at freecreditreport.com, you got to tell them, well, you understand when you pull credit, it's going to be different, because a lot of people are shocked by the fact that it's gone down.
So you said monitor your credit every couple of months, every 3 months. What service do you use?
I started using Credit Keepers, which was a really good service for a while. TransUnion ran it, and then Credit Karma's come out with a nice program. I keep an eye on my stuff through Credit Karma. I like it. It's straight up, and
is the score then equal to what?
no.
No.
It's not going to be equal to what it would be if you were applying for credit. And every time if you pull it online yourself, it's a soft inquiry, it doesn't hurt your score. If you have it pulled as a hard inquiry by a lender, auto place, whatever, it's hard, and it'll ding your score a couple of points. Yes, ma'am.
Yeah, I'm just going back to leaving the positive accounts on the reports. What happens when they are dropped from your credit report? How do you get them put back on?
Wow.
Sorry.
No, that's a great question. I've never had a scenario in 6 years of doing this that I've had a client. No, I don't. I know if you close an account. I mean, I guess it would be if you close if you have an account that's a credit card account that's active and you close it, you can go back to the credit card company and they will pull your credit and then they will relist the account. But I've never had a client who had a positive account, other than that one lady who closed her stuff.
What about car loans and mortgages?
You would have to go back to the mortgage company, the car company, and ask them to put it back on there. That's a good question. I'm going to look into that.
Yeah, because I've had it on my personal account.
You've closed it or had somebody close it?
Oh, you pay off mortgages, you know, the cars a long time ago, but it drops off from your credit report.
After a while.
Yeah.
Yeah, and by that time, you've established enough other credit that it's not going to be a big hit. The longer it stays on, the better the points are going to be. And if it drops off after it's been 10 or 15 years, it may not be as big a hit. But that's a good question. I've never get stumped. No, I do. That's awesome. Lost credit cards. If not delinquent, lost credit cards are listed for 2 years. If they're delinquent, they can stay for up to 7. Inquiries, most inquiries listed will stay for 2 years. Inquiries start to drop in point value after the first 30 days. And you'll get hard inquiries, soft inquiries. You get an inquiry that has an impact. You get inquiries that don't. But you can challenge inquiries just like you challenge everything else, and they come off really easily. Because most of the time, nobody responds to the inquiry request because what's the point? If you send a letter saying, I did not authorize this and this and this, they'll just take them off. And more than 3 is hurting your score. So if you have a whole bunch and you want to do that route, you can do it. You do that at the end of the dispute process. Names, same thing. Alias names, more than 3 alias names. Under the 2003 identity theft laws that came into play after 9/11, you have the right to have one name and one address on there if you want it. So you can go in and have bogus address off, have bogus names off, and that'll help the score a little bit, not a lot of points. Let's see. Here's a basic average across the board of what these can cost you in an average credit dinging that I found over the last 6 years.
What's a foreclosure?
100. Well, it ranges. Who asked that question? It can range from, I've seen them from 60 up to 100 and 150, 160. Again, the more positive credit, the less of the negative impact really is in the long Let's see, we'll just go through this. No, we know who reports. Creditors fill out an application. They have to pay the credit bureau to report your information. We touched on this, that the thrifty creditors won't report to all three bureaus. That's why the three scores are different. So if anybody ever asks you, how come my scores are all different, that's why. Some people, and if you look at the report, you'll see. Some credit card companies report to one bureau, others report to two, and some will report to three.
You mentioned Credit Karma. Does Credit Karma actually look at all three bureaus?
You have to pay for
The
it.
individual?
You pull it, you can get a report from Credit Karma, you have to pay for it.
Yes.
Yeah, and scores too, typically.
How does a short sale show up?
Well, short sale is another monster in itself. You know, the whole short sale entity, which I think is a farce, because you know, a short sale is your ability to pay off something in a shorter amount of money that a bank agreed to accept. So why is it listed on that the account's been paid for less than full amount, when you agreed to have it as the amount that they accepted? The other thing is a short sale is classified as an M because it's a mortgage, and it should be no higher than an M3. A foreclosure is classified as an M9, and that's the highest rating you can have and the most, you know, devastating points you can have as an M9. So when you're in negotiations with a short sale with a bank, you want to ask the question, hey, how is this going to report on my credit report? And, you know, it should never be higher than an M5. I mean, I've seen M5, M3, M5, they're right around the same point values. But M9, it's not an M9, it's not an M6, 7. Anytime you get higher up in the numbers, the points are going down. So you could have somebody that's reported as an M9 and get the bank to agree to report as an M5, and you could see 40, 50 points come back on their credit score. So in negotiation of a short sale, you want to say, hey, look, how's this going to be reported on my credit report? You know, it should be reported as an M. M1's a perfect paid mortgage, M2's lates, M3 to M5 is usually the short sale variances. So I would say no higher than an M5.
So if I have a client that has a short sale that they've done, let's say 2 years ago, which actually I think it's 2 now. But anyway, and if they looked at their report and it is a higher thing, then I can tell them
Yeah.
to one, look at the report,
Yeah.
two, if it's higher, to question.
Oh yeah, absolutely, because the bank put it on there. The credit bureau didn't just choose M9. The bank sends the transaction, and somebody at that bank needs to be responsible for that. They'll tell you they aren't, but they do need to be. Is that answer your question, Mark? Okay. Once they subscribe to the service, they're allowed to report information on your credit history. You're not required to. There's a national database that's in Herndon, Virginia. It's called eOscar. eOscar is an acronym for Online Solutions for Complete and Accurate Reporting. It was developed by the three bureaus and also Innovus. It was supposed to be the data hub where all the data is kept. What you got to understand about the credit dispute process is this. Your data is here. Everybody's data is here. It's a secret data farm in Herndon somewhere. I have no idea where it is. I'd love to find it. When you send a dispute letter to the credit bureau then takes your data into their system. And one of the games they play is they send a letter to a customer that says, we don't have your information in our system. Well, of course you don't, because it's here. But then they'll go get it. Now, it's here. So the dispute is done here in the data system. Deletions and updates are not real time. They take about 7 to 10 days, sometimes 14 days to hit the credit report. I have clients all the time, they'll call me and go, I got 5 things deleted. My score hasn't gone up. Why not? Well, because it's not real time. It just happened. Give it 7 to 10 days. They will not transmit the data back to eOscar where the scores are generated until the whole completion of the investigation is done. That's why you can't go from round 1 to round 2 to round 3 until everything is back. And clients want to say, oh, I got 5 letters back, let's send the new set. You can't. You have to wait the time period. And the credit bureau elongates it, and it just gets ridiculous sometimes, as much as 60 days. And it's out of your control. You have no control over it. So everything is kept here at the eOscar location. It's pulled into the main database. That's where the dispute and everything is done. And then it's all transmitted back to eOscar, where the score is then updated. So that's why it takes the time period. That's why the credit bureaus want 30 to 45 days to get everything done. FICO score was created back in 1956 because they figured if they used intelligent information, it would help them with lending decisions. That's how FICO came into business. It became a way to evaluate your credit. 90% of everything, according to a recent study, uses FICO scoring. They came up with a score a couple years ago called the Advantage score. And I think Experian and Equifax were messing around. And the Advantage score was supposed to be a grading scale from A to F. The scores condense a buyer's credit to a three-digit number. 3 to 850 is what it usually is. Most people are in the 6 to 700 range, and only 1 in 1,300 are in 800. Now, how many of you have an understanding of what the three-digit number actually says? Any of you? Yes, sir.
What does it say?
No, the three-digit number, what is it an indication of?
I guess just, I mean, as far as the score that's reported,
Mhm.
yeah, it's just, that is a compilation of the history, the percentage of the use of the credit, like you said, and, it basically, I'm a mortgage lender,
Mhm.
so, we get those scores, we review those scores, and like you said, that is a big basis of the type of interest rates you're gonna get, the programs
Right.
you're gonna be eligible for, so it's a pretty big deal, for us to see what those scores are.
The three-digit number that is mathematically calculated, that's the, let's say it's your middle score. Anybody have an idea what the three-digit number actually says about you? How they've come out with it, and what has happened with the credit industry itself is everything's based on that three-digit number. What'd you say, Mark?
I said the ability to pay it back.
Absolutely, the ability to pay it back, the ability to use that number, but that number is an indication of whether you will default on credit within 90 days. That's what the number really comes down to. The lower the number, the higher the risk, the higher the number, the lower the risk. So that number has become the fingerprint of whether you're a risk at defaulting on your mortgage or defaulting on the loan that they're gonna give you, whatever it is within the next 90-day period, is what that's come down to. Each one uses their own predictors. Each credit bureau uses different numbers, that we talked about that earlier, to get the final score. TransUnion still uses their FICO risk score classic. They go from 3 to 850. Equifax goes from 3 to 850. They still use their beacon scoring. Fair Isaacs goes from 330 to 830 for Experian. And then the Vantage score goes from 501 to 990. Any of you ever had a client that said, I got a 990 credit score? Well, what they were trying to do is, Fair Isaacs charges a lot of money for their algorithm situations and their softwares and so forth, and the three credit bureaus pay for that. So what the three credit bureaus and Innovus decided to do is they're gonna come up with their own scoring system. And we're gonna sell this scoring system to the mortgage industry, and we're gonna start using it. Well, it's not gonna happen. I don't think it's ever gonna happen. It's being used in some areas, and it's being used in some evaluations, but it's graded on an A to F scale. And so if you ever hear a client say, well, my Vantage score is this, most lenders will not use a Vantage score. All right, this is what we went over this. I jumped ahead of myself. They use it as a yardstick to figure out if you're gonna default within the next 90 days or less. We covered that. The algorithms that are used are so complex that when Congress took them to court, they couldn't show how they did it. They just have their own way of doing it, and they let it go. They didn't push it any farther. Anyway, everything is listed on the credit report. We all know major derogatories: time of your job, occupation, present address, balances, inquiries, number of credit lines, the number of years you've been, in the credit bureau database. How'd that get over there? Let me just run through this real quick. And this is what I was talking about, the things that are out of your ability. And this was from the 1999 court hearing, where the credit bureaus tried to prove how the scoring models would work and how things affect the scoring. So if you start at the own and rent, if you look at the top, if you own a house, you may get 25 good points. If you rent, you get 15. Other, if you're living with your relatives, you may get 10. If there's no indication at all, you get 17. So you get more points for no indication than you do for other indication. And that's just one entity. Yours at the address. Each one goes up the longer you live at the address. Your occupation. If it's a professional occupation, you'll get the highest number of points. And it goes across the board. And these are live factors that they've used over the years to calculate scores. Credit cards. If you don't have any cards, you get none. Department store could give you 11. Major, if you have both, you need to mix your revolving credit. You need a bank card. You need a revolving credit card from a store card. You need a gas card. If you're going to have revolving credit, you should have 3 credit cards. You should have at least 2 major bank cards and 1 Kohl's card or Radio Shack or gas card, because it's scored as lower, but it's mixed, and they love to see the mixing of them. Bank, if your kids want to establish credit, get them a checking and a savings account early, because they'll get more scores, they'll get more points if they have a checking and a savings account than if they have None indicated at all. Inquiries, we covered that. Years in the file, the longer you're with the credit bureaus, the higher your score goes. So these are things that you have no control over, and the list goes on and on and on. I pared it down for Mark from the last thing because it was so long. But this is just to give you an idea that there are things you have no control over that drive your credit score. Okay, he touched on it a little bit, the whole way your score is made up. 35% of your score is based on your payment history. 30% of the score is based on the amounts that are owed. 15 is based on the length of your credit history. The longer you have an account, the higher it's going to score for you. 10% of the score is based on new credit, and then 10% of the score is based on the types of credit used. This is really the key here. You really want to try to have installment and revolving. If you want to have a good credit score, you want to try to mix revolving and installment credit. If you don't have a mortgage payment, if you don't have a car payment, if you don't have an installment line, you're never going to get the high score that you may be looking for because you're living off revolving. Any questions? I know it's depressing. It really is. It's a big scam. I mean,
It is.
it really is. And, you know, and we're going to transition, but you know, credit's the most valuable tool in the world, but cash can't come close. But if you know how to utilize your credit, or you have the knowledge how to get your credit score way to go, then you're on top of the game. You really just need to take advantage of your credit reports and look at yourselves first and say, okay, what can I do to make my score better, and then try to maximize it. If you're going to use credit, if you're not going to be using credit, what's the point? You know, but again, it's not a quick fix. It's going to take, you know, at least 45 days minimum and as much as 120 or more. Yes, sir.
If you have children, can you open up an account at a credit union at like a very young age to start the clock, I guess?
You can, but it won't have any benefit for them initially until they're old enough to you know, 18, to be able to establish their own credit. Adding a child to a card as an authorized user, great way to start. You know, you can put your son or daughter on your existing credit card, and then what you have to do in that is you have to have that card sent to you in their name, and that card has to be activated, and then cut that damn card up and throw it away. Don't give it to them, you know, because I'm sure you all know, you know, I gave my son a $300 max card with a limit when he went off to school, and I said for emergencies only, and 2 weeks later, he called me to say, Dad, I can't use the card, and Chipotle and gas and all that stuff was on there. So add them to a card. What you got to do, they don't have to use that card. That card's not individual. It's on your account. So eventually your account will end up on their credit report. And that line item will be as if it was theirs from the start, which is really silly because if you've had that credit card for 5 years, they just turned 18, that means they had that credit line for, you know, since they were, you know, 13 years old.
Well,
But it'll still benefit them. It'll go on there.
Would you say would be, what's the age?
18. I don't think the credit card company will give you, they won't allow it unless they're 18. But you could open a bank account, a savings account, or a checking account early, you know, or at least a savings account to get them started. I put together a pilot program, what was it, 5 years ago we were going to do that? Yeah, it was 5 or 6, well, yeah, right after, so 5 years ago I put a pilot program together called Credit 101. It was for graduating seniors. And it was a 3-hour class on credit. And Fairfax County shot me down immediately for insurance and for legality reasons or legal reasons. And then Loudoun County, did my presentation for Loudoun County, and then Loudoun County said, nah, we're not going to do it. And come to find out now they're doing their own little credit thing. Yeah, well, yeah. But, I mean, every senior needs to know, everybody needs to know, kids need to know that. They really, really do. You know, and unfortunately, they don't get that education. The 4 laws, I'm going to touch on it real simple, so because everybody needs to just have. These are the 4 laws that protect you, that make you strong in this area: Fair Credit Reporting Act, the Fair Credit Billing Act, Fair Debt Collection Practices Act, and the Fair, Accurate, and Credit Transactions Act. And I'm going to touch on each of them very, very simple. Again, Mark, I pared this down as your request.